Hello, everyone. Chris Hobart here. Welcome back to another episode of the Wealthologist Weekly, where we help make sense of what's happening in the world of finance so you can make some smarter decisions with your money. And today, I want to dive into some big news that came out of Jackson Hole last week, where the Federal Reserve Chairman Jerome Powell made it very clear change is coming next month. The markets are already buzzing about the possibility of rate cuts, either 25 or 50 basis points. For those of you that need that understanding cleared up a bit, that means 0.25 or 0.5% reduction in interest rates. And that would happen at the Fed's next meeting on September 18th. But here's the thing. While everyone's fixated on interest rates, we actually think that there's a lot more to the story when it comes to monetary policy that we've got to keep our eyes on. So let's talk about what's really happening behind the scenes. Back in 2008, we all remember that, the world seemed like it was falling apart. The Fed at that time introduced something called the abundant reserve policy, which essentially decoupled the money supply from interest rates. Now, this means that while interest rates are important, they're not the only factor driving our economy, as they really had been in the past. In fact, now one of the most crucial things we watch is the growth rate of what's called M2, which is a measure of monetary supply that includes cash, checking deposits, and what are called easily convertible near monies, liquid things. And this is where it gets kind of interesting. M2 can now be heavily influenced by the U.S. Treasury and the $730 billion it holds in what's called the Treasury General Account, or TGA, at the Fed. It's kind of like a slush fund account, if you will. Now, we believe the real reason inflation has slowed down recently is because the Fed allowed M2 to shrink after its massive COVID-era spike. Now, sure, short-term interest rates were extremely low during the pandemic, but if those low rates were the only cause of inflation, we'd seen similar surge in 2008-2009 financial crisis, but we didn't. Instead, the recent drop in inflation, it's more likely has something to do with the slowdown in M2 growth, which is strategic because that's partially driven by the TGA, which essentially took $700 billion out of circulation. Now, this whole system where the Treasury can affect money supply by parking or spending its funds, well, this has brought us closer to something called modern monetary theory, or MMT, in the financial world. Now, that's where the government can control the economy by borrowing, taxing, and spending on a massive scale without relying solely on traditional interest rate policies, again, which is what we've historically done. But here's the kicker. We're kind of in uncharted territory. We really don't know how the Fed or the Treasury will handle things like quantitative easing or the TGA in the future. Some people think cutting rates will help the U.S. avoid a recession, but with M2 barely growing, that might not be enough. You see, since 2008, the Fed has kept short-term interest rates below inflation rates for 80% of the time. For 9 years, rates were practically zero. Even if the Fed lowers the federal funds rates to around 4.5%, which might seem normal given the current inflation of 2.5 to 3%, that doesn't mean that we're out of the woods. I also want to touch on housing market a little bit because this can impact that. Even if the Fed starts to cut rates, I don't want you to expect that mortgage rates are going to drop back down to 3%. Because if that's the case, I don't think that's very realistic, and it might cause people to hold off on buying homes, anticipating even lower rates in the future. Plus, there's now tax credit conversations for buyers being floated around, which could even create more delays in the housing market. So what's the bottom line? The Fed's been experimenting with a new approach to monetary policy. So don't think that shifting from higher for longer to lower rates is the magic bullet to really stick the landing like it may have been in the past. We're still dealing with the after effects of COVID-19 lockdowns, and it's hard to imagine that we're going to escape all of that unscathed, specifically when we printed 40% new currency during that period of time. There's also a growing concern about the direction our economy is heading. In the past year, 82% of all new jobs have been in government, healthcare, and education. Meanwhile, the economy has been propped up by growing budget deficits, even as the money supply has dipped into negative territory. So with deficits not rising as fast, the Fed may try to pick up the slack, but that could be risky, and it might reignite inflation. Just last week, gold hit a record high. And Bitcoin also surged. The markets aren't fully convinced that inflation is under control, and neither are we. So, what does this all mean for you? It's a reminder to stay informed and think critically about where our economy is headed and what plans are being made for the economy. The decisions the Fed and the Treasury make in the coming months could have a big impact on your finances. Now, if you found this breakdown helpful in understanding what's going on right now in the economy, don't forget to like and subscribe to our channel on YouTube for more insights on how to navigate these turbulent times. And as always, I'm Chris Hobart with the Wealthologist Weekly, here to help you stay ahead of the curve. So until next time, have a great week.